Welcome to the Deep Dive. We cut through the earnings call noise, distilling the essential knowledge, specifically for you, the astute investor. Today, we are plunging into the Q2 2025 earnings call from Seaport Entertainment Group. You probably know them as SEG. Our mission: to really unpack their latest performance, decipher their strategic moves, and help you understand what this all means for their future and, well, for your investment perspective. Let's get right to the headline numbers. This quarter had some pretty significant shifts. SEG reported total consolidated revenues of $39.8 million.
Which is a very solid 18% increase year over year. That's not insignificant.
Right. Now, while they did still post a GAAP EPS loss of $1.16 and a non-GAAP adjusted EPS loss of 58 cents.
Which, still losses.
Still losses, yes. But the direction is the key here. We saw a clear, I'd say, dramatic trend towards narrowing those losses. Net loss improved massively.
Yeah, down to $14.4 million from, $35.0 million in Q2 2024.
Exactly. A huge improvement.
And what's fascinating about that net loss reduction isn't just the number itself, but how they got there.
How did they do it?
Well, it was significantly bolstered by a substantial 55% reduction in general and administrative expenses, G&A.
Wow, 55%.
Yeah. Down to a lean $8.3 million. And, this isn't just trimming a little fat around the edges. This feels like a strategic scalpel.
Okay.
It signals, I think, leadership's aggressive commitment to a leaner, more focused operating model. They might be prioritizing core assets, maybe even at the expense of some slower performing legacy operations. The real insight here is the conviction, behind this operational overhaul.
And that conviction seemed to fuel their operations too, particularly in the entertainment segment.
Oh, definitely.
Operating EBITDA, that crucial measure, of core operational profitability, stripping out financing and accounting quirks, it surged an incredible 122% year over year.
122%. That's huge for that segment.
And total operating EBITDA for the whole company, up 95%.
So strong operational momentum across the board, essentially.
Mostly. Even same-store hospitality revenue saw a modest 1% increase. But here's the kicker. Despite these seemingly positive indicators, and really quite an upbeat tone from management on the call, the market's initial reaction: a slight dip in the share price on the day of the call.
Right. That initial dip is where it gets interesting for us, doesn't it? You have to wonder, what was the underlying skepticism there? Is it simply the continued losses despite the improvement? Or is there maybe a deeper concern about the execution risk, and their strategic pivot?
Good question. We should delve into why that might have been and how the situation has evolved since. Let's go deeper.
Okay.
Absolutely. To truly grasp the dynamics, we need to dissect the different revenue streams, because it's here that the story of SEG's future really starts to unfold. So breaking down that $39.8 million revenue, the segment mix for Q2 was entertainment leading the charge at $19.9 million.
Almost half right there.
Yeah. Hospitality contributing $15.2 million, and rental making up the remaining $4.2 million.
So clearly the entertainment segment didn't just drive momentum.
It catapulted it. Much of the quarter's performance, really.
And that entertainment segment's performance is truly the highlight. Revenue up 16% year over year.
So what drove that 16%?
The primary drivers: an impressive 11 additional concerts at the Rooftop at Pier 17. That pushed the total to 22 shows for the quarter.
Double the previous year.
Exactly. Plus higher sponsorship and concession revenue from their Las Vegas Aviators baseball team. It really speaks to the surging demand for live experiences right now.
Okay, so what's the secret sauce then behind Pier 17's explosive concert success? Because it's not just that they doubled the concert count.
No, it's the performance within those concerts.
Right. They had an impressive 15 sold-out performances, a sell-through rate over 90%.
Which is fantastic. And they made a point of saying it's reportedly outpacing similar venues nationally, not just local success.
Okay, that's a strong claim.
It is.
And they're leveraging this demand too, right? With new premium upsell opportunities, things like the Liberty Club and the Patron Patio.
Yeah, that Patron Patio opened in July. It's a 2-level elevated lounge and bar, apparently with stunning views.
So this feels less like simply responding to demand.
And more like actively creating a premium experience around it, trying to capture more wallet share per attendee.
It makes sense.
You're right, though. It's about more than just booking acts. And this raises an important question, I think, for long-term investors.
Sustainability.
Exactly. How sustainable is this concert demand, especially in what can be a pretty fickle market?
So how are they addressing that?
Well, SEG seems to be addressing this head on. They have plans to invest in a temperature-controlled winter enclosure for Pier 17.
Ah, interesting. A winter bubble?
Something like that. Slated to open by the end of November this year, the goal is to transform it into a year-round destination, extending their programming into the colder months.
Okay, that suggests a very deliberate, long-term play on live entertainment. Future-proofing a key asset, essentially.
I think so. It's a big investment, but potentially a game changer for that venue's revenue profile.
And a well-calculated one if that winter enclosure truly opens up year-round revenue. But, what are the unique challenges there? Attracting a winter audience to a potentially outdoor venue, even if enclosed? Is it a different crowd?
That's a fair question. Something to watch.
And it's not just Pier 17 making moves either. The Las Vegas Aviators securing a playoff spot.
Right. That meant adding 2 home games.
Which is basically SEG's own version of unexpected overtime revenue, bonus content.
Yeah. And they're also actively internalizing the operations of Enchant. That's a popular winter holiday event they host at the Las Vegas ballpark.
Why internalize?
Well, they said it's smart for enhancing guest engagement and, crucially, leveraging ticketing data. Owning the data, owning the customer relationship more directly.
Got it. Makes sense.
However, it wasn't all upside. They did note a year-over-year headwind in Q2.
Oh.
Yeah, due to the absence of the Savannah Bananas exhibition baseball team. They played in Q2 2024, but not this year.
Ah, the Bananas. They draw crowds. So, a small but noteworthy detail.
Indeed. While entertainment is clearly the star, let's not overlook the elephant in the room.
Hospitality.
The operational reset in hospitality.
Yes.
While same-store hospitality revenues increased by that modest 1%.
Which is positive, technically?
Technically. But overall, consolidated hospitality revenues declined 15%.
Okay, that's a significant drop. Why?
Primarily due to reduced operating hours and some select venue closures at the Tin Building. Plus, some weakness at their standalone restaurants.
The Tin Building again?
However, new venues like Atano that had its grand opening May 1st and the continued success of Lawn Club, they did help offset some of these pressures.
So it shows a bit of a mixed bag, indicating that the strategic pivot isn't without its bumps in the road.
Definitely challenging.
So the Tin Building, it's been a known challenge for a while now. What's management's latest strategy to tackle its persistent cash burn? Are they making progress?
Well, management highlighted that stabilizing the Tin Building and dramatically reducing its cash burn remains a top priority. They said they're actively developing an amended operating plan with John George's restaurants. That's crucial.
Okay, an amended plan.
But more profoundly, SEG finalized structural changes to fully internalize food and beverage operations there.
Fully internalize? How?
They obtained 100% of John George's interest in the Tin Building joint venture itself. And they replaced the old management agreements with new license agreements.
So they took over operational control?
Essentially, yes.
Yeah.
They do still hold a 25% ownership stake in John George's restaurants overall, but for the Tin Building operations, they're now in the driver's seat.
That sounds like a big move.
It is.
Yeah.
This isn't just about tweaking efficiencies. It's about gaining full control over a challenging asset, taking the reins to try and steer it towards profitability themselves.
But the question for you, the investor, is how deep are the structural issues there? And what's the realistic timeline for seeing that cash burn truly reverse? This isn't just reducing losses anymore.
No, it's about proving they can execute a complex operational turnaround. That's the real test.
That full internalization is a big bet then, consolidating control to hopefully drive a faster turnaround. Okay, shifting gears slightly, what about the leasing front?
On leasing, SEG signed 2 new long-term leases. This was for previously vacant space in the historic Cobblestones district.
Oh, yeah? Who's moving in?
Willett's NYSE and Cork Wine Bar. The idea seems to be a deliberate move to diversify the traffic drivers down there, bring some new energy to the area.
Adding more reasons for people to visit the Seaport.
Exactly. They also noted Nike's early termination right for its office space at Pier 17.
Oh, Nike's leaving early.
Well, their lease expiration changes from Q1 2030 to Q1 2027. So yeah, earlier than planned.
Is that bad news?
Yeah.
Losing a tenant like Nike.
It comes with a $4 million termination payment, half of which they already received in Q2. And SEG actually framed this not as a setback,
But as?
an opportunity to expand their own hospitality and entertainment offerings in that neighborhood, potentially lining even better with their core strategy.
Turning lemons into lemonade, maybe?
Perhaps. It fits the narrative. And this brings us to another monumental piece of news.
So on.
The significance of the 250 Water Street sale. It really cannot be overstated.
Right. They announced an agreement to sell it. For how much?
$150.5 million, with the closing targeted by the end of 2025.
That's a big number.
It is. And this isn't just a property sale. It feels like SEG shedding its skin. Management called it a significant milestone.
Why so significant? Beyond the cash, I mean.
Because by offloading 250 Water Street, they're not just improving the balance sheet, though that's huge. They seem to be explicitly abandoning their development-heavy past
And fully embracing.
an entertainment-centric future. The insight here is the clarity of this strategic pivot, and the boldness, maybe, in sacrificing a major asset to redefine their core identity.
It's a very clear signal to the market.
Yeah.
Okay, so looking ahead, what's the target?
Management is targeting operational break-even in 2026.
Break even. That's the goal line. Ambitious, but critical.
Absolutely. They're expecting Q3 tailwinds from the summer concert slate, obviously, and upcoming events like the New York City Wine and Food Festival in October.
Right. The Seaport is the main campus for that this year, and John George is the culinary host.
Correct. They also flagged some one-time expenses coming in the latter half of 2025, mostly for technology improvements.
Investing in the future, presumably.
Before aiming for further improvements in their corporate G&A run rate in 2026. So it's a layered approach. Short-term event benefits, long-term tech investment, and continued cost discipline.
Seems logical.
And for you, the investor, there's another crucial development. Might fly under the radar a bit.
What's that?
SEG successfully uplisted. From the NYSE American to the more prestigious New York Stock Exchange. That was back in June.
Okay, the big board.
Yep. And they were subsequently added to the Russell 2000 and Russell Microcap indexes.
Why does that matter?
Well, this isn't just a vanity move. It's anticipated to improve visibility, attract more institutional investors, maybe significantly increase trading volume.
Which all benefits shareholders in the long term, potentially. More liquidity, maybe a valuation boost.
Exactly. It's a subtle but powerful endorsement, I think, of their evolving business model.
So for you, the seasoned investor listening, the narrative here really is one of aggressive strategic repositioning.
Absolutely.
SEG is clearly shedding that complex, development-heavy profile to become a leaner, entertainment-centric operator. It's a very deliberate story they're telling and executing on.
Exactly right. And that sale of 250 Water Street is such a critical deleveraging event. It provides much-needed capital that can now be redeployed into their core entertainment and hospitality assets.
Right, fueling the new focus.
And the strong performance of the entertainment segment, particularly those Pier 17 concerts, it truly demonstrates that their bet on record global concert demand is paying off. They claim they're even outperforming industry comps in live events there.
Which is impressive, if true.
The challenge, as we discussed, remains stabilizing the tin building and achieving consistent profitability in the broader hospitality segment. That's not solved yet, but the focus on cost discipline and portfolio simplification is undeniable.
So while that initial day of market reaction was that slight dip, maybe reflecting some lingering skepticism about past performance or execution risk, the subsequent rebound, especially alongside the 250 Water Street announcement, suggests the market is beginning to appreciate the strategic shift and the potential catalysts ahead.
Like what?
Well, think about the Q3 concert season throughput, the impact of these new concept launches like Meow Wolf, Willett's NYC, Cork Wine Bar, and any future balance sheet moves after they get that $150 million.
Right. How they deploy that cash will be key.
This narrative could compound beautifully if execution steadily converts all that foot traffic into actual margins within their whole destination district thesis. It's a story of transformation, but the proof, as always,
will be in the quarterly margins.
Yep. All right. So with this strategic repositioning in mind and the market maybe starting to recognize these catalysts, for you, the astute investor, the question becomes, how might one potentially play this?
How to trade the transformation.
Exactly. Which brings us to our wild yet plausible trade idea for this quarter. And remember, everyone, this is not financial advice, just an idea to consider.
Okay, let's hear it. Given the strong execution in entertainment, but the uncertainty elsewhere, and the pending catalyst of the 250 Water Street sale, I'm thinking a long straddle on SEG.
Long straddle. Okay, explain that for folks. Betting on volatility.
Exactly. For our option-savvy listeners, you're buying both a call and a put option with the same strike price and expiration date. You profit if the stock makes a big move, up or down. Doesn't matter which way, just needs to move significantly.
So what's the thesis for the up and down moves here?
Well, we're buying an out-of-the-money call for a potential upside surprise. Maybe that operational break-even happens sooner than 2026.
The optimistic case.
Right. And we pair that with an out-of-the-money put for the downside risk. Maybe a tin building turnaround disappointment, or they make an unexpected capital allocation misstep with sale proceeds.
Hedging for things going wrong. Okay, that's the straddle. What's the twist?
The twist, we're funding part of this, notionally at least, with a short iron condor on Live Nation.
Whoa, okay, short iron condor on Live Nation. Unpack that.
The short iron condor is an option strategy that profits if the underlying stock, in this case Live Nation, LYV, stays within a defined price range until expiration. It involves selling a put spread and selling a call spread. It's a bet on low volatility for LYV.
Okay, so betting on volatility for SEG and low volatility for Live Nation. What's the connection?
The thesis here is a relative value play. If SEG truly outperforms the industry comps in live events, like they claim with Pier 17, then maybe some of that overall industry tailwind is subtly diverted from, or at least less impactful for, the absolute behemoth that is Live Nation, especially if things like local market saturation start to factor in.
So you're betting on SEG's localized outperformance versus Live Nation's broad market dominance, maybe facing some friction.
Kind of. It's a play on localized outperformance versus the broad market leader, hedging our bets on SEG's specific catalysts while maybe capitalizing on potential slight relative underperformance or just stagnation in the broader sector giant.
It's definitely aggressive, but it highlights the divergent paths we're seeing, or could see. Interesting idea.
Wild but plausible, right?
Fits the bill. Okay, so let's summarize. Seaport Entertainment Group's Q2 showcased significant progress in narrowing those losses.
Driven by that booming entertainment segment and some really aggressive cost cutting, not just trimming, cutting.
Right. The planned sale of 250 Water Street is clearly a pivotal, maybe identity-defining move. Strengthens the balance sheet, frees up cash to fund future growth in their core areas entertainment, and revitalized hospitality.
Yeah, the path to operational break-even in 2026 isn't guaranteed, obviously. It's not without challenges, particularly that complex tin building turnaround.
Still the big question mark there.
But management's strategic focus and their execution lately are showing promising, albeit still early, results. They're telling a powerful story of transformation.
And the numbers are just starting to back it up. We've distilled these insights specifically for you today. Hopefully they spark your next big idea or refine your perspective. As always, this is the deep dive, and the information discussed here is purely for informational purposes. It is absolutely not financial advice.
Please do your own research. Consult with a qualified financial professional before making any investment decisions.
So, as SEG sheds its old skin and really embraces this entertainment-centric future, the real question for you, the astute investor, might be this. Can a company truly transform its identity and market perceptions so deliberately? Or will the ghosts of past development projects continue to cast a shadow on its entertainment-led ambitions?
Something to mull over as we watch their next quarter unfold.
Definitely. Until next time.